All right, class, settle in. Today, we're going to break down a really important update to India's tax system, something people are calling GST 2.0. The big idea here is a concept called tax rationalization. We're going to cover what that is, why it's even being talked about, and, well, a pretty big challenge that could make or break the whole thing. So let's get started. Here's our lesson plan for today. First, we'll get a handle on what rationalization actually means. Then we'll look at the 7 big goals behind this change and break down the new tax slabs they're proposing. After that, we'll talk about what this could mean for the economy and tackle a really critical hurdle, before finishing on a huge unresolved question. Okay, first things first. Before we can really get into GST 2.0, we have to understand the main idea driving it, and that idea is called rationalization. So, what in the world is tax rationalization? A lot of people hear that and think it just means cutting taxes, but that's not quite right. A much better way to think about it is like tidying up a super messy room. The goal isn't just to throw things away, right? It's to organize everything, make it logical, make it efficient. And that's exactly the idea here. To make it even clearer, let's compare it to something you might have heard of: subsidy rationalization. With subsidies, the whole point is to make sure the right people are getting the help they need. It's about targeting. With tax rationalization, it's about building a smarter, more streamlined system for everybody. See the connection? Both are about making things more efficient, not just making random cuts. Okay, so now that we know what rationalization is, it's time to get to the why. Why go through all this trouble? Well, there are 7 core reasons driving this whole reform. And here they are. This is basically the 7-step game plan. It all starts with building on that original one nation, one tax idea. It's also about making taxes fairer, especially for lower income folks, and just simplifying the whole confusing system. And of course, the big goals are to help you, the consumer, with lower prices, give a boost to small businesses, and ultimately get the whole economy growing by encouraging more spending and investment. Now for the part everyone wants to know about: the numbers. One of the biggest changes in GST 2.0 is moving away from a really complicated system to a much simpler 3-slab structure. So the whole idea is to get rid of some of those rates you see now, like 12% and 28%, and replace them with this cleaner 3-tiered system. Let's take a quick look at what each of these new rates is supposed to cover. First up, we've got 5%. This would be the new base rate, the one that applies to most common everyday goods and services. So for a whole lot of stuff you buy, this is going to be the number to watch. Next, we have 18%. This is the other standard rate. It'll cover a whole bunch of other goods and services that don't quite fit into that 5% basket. And finally, we get to the big one, 40%. Whoa. Now, this is a special, really high rate, and it's reserved for what are called demerit goods. Think things like tobacco or super fancy luxury cars. The idea here is to discourage people from buying them while also bringing in more tax revenue. Okay, so we've got a new structure, we've got new numbers, but what does it all actually mean for you, for me, for the country? Why should we care? Let's talk about the expected economic impact. The hope here is that this whole thing creates a kind of positive ripple effect through the economy. A simpler tax system, that makes it way easier to run a business. Lower prices for us, that improves our day-to-day lives, and hopefully means we spend a bit more. When we spend more, businesses invest more, and you get what economists call a multiplier effect. Basically, it helps the whole economy grow. But, and there's always a but, isn't there? This plan isn't without its challenges. It all sounds great on paper, but there is a major potential problem we absolutely need to discuss, and that's the problem of profiteering. So, this is the most important part of the whole lesson, right here. When the government cuts the tax on something, the price you see on the shelf in the store should go down. That's the whole point. That's how you, the consumer, are supposed to benefit. Let's do some quick, easy math to see how it works. Let's say something costs 100 rupees before tax. With the old 12% GST, the final price was 112 rupees. Simple enough. Now, with the new 5% GST, that exact same item should cost you 105. The price should drop by a full 7 rupees. But here it is, the critical question. What if you go to the store and the price is still 112? Or maybe it only dropped a little to 108. Where did the rest of that tax cut go? This is exactly what we call profiteering. It's when a business takes that tax cut, that money that was supposed to go to you, and just keeps it for themselves. They pocket the savings. And this one practice could completely wreck one of the most important goals of this entire reform.
And that leads us to our final and honestly most confusing chapter in this story. If profiteering is such a big risk, then who's supposed to be the referee? Who's watching the prices to make sure companies are playing fair?
Well, believe it or not, there was a watchdog. It was called the National Anti-Profiteering Authority, or the NAA, and it was created back in 2017 to do this exact job. But its journey was, well, pretty short. It was eventually broken up, its duties got shuffled around, and as of today, the final body in charge is no longer taking on any new anti-profiteering cases. And that, my friends, leaves us with a massive open-ended question. If you have a tax system that's designed to help consumers, but no one is really there to enforce it, then who makes sure those savings, those benefits, actually make it into your wallet? That is the unresolved multi-billion rupee problem right at the very heart of GST 2.0. Something to think about.